Well, with the end of the year approaching, it's time to think about tax strategies. We're joined now by an expert to talk about things like charitable donations, stock loss harvesting, and making contributions to your registered accounts. Let's bring in Ali Spinner, tax partner at Crowe Soberman LLP. Ali, thanks a lot for joining us. Let's talk about charitable donations. A lot of us get envelopes at this time of year from charities hoping that we will send some money their way. What should taxpayers keep in mind about this time of year and charitable donations?
Sure, it's a great question. A few things that taxpayers should keep in mind is that if they want to make sure that they can get their tax benefit for 2023 from making those donations, they have to make sure that they make those donations by December 31st. So if you're going to be writing a check, sending cash, charging your credit card, make sure it's done by December 31st. Something that taxpayers should keep in mind is that a really great and efficient way to make a donation is to donate appreciated stock. There's a really big benefit that comes with donating appreciated stock in 2023. When you donate that stock, if you have a pent-up gain in the stock, the good news is that on the donation of the public company shares, you won't pay any tax on the appreciation when you make the donation of the stock, but you'll still get a full donation receipt for the full fair market value of the stock. So it's a great way to shelter tax on the stock itself, on the gain in the stock itself, as well as get a full donation receipt for the full fair market value of what it is that you're giving away to the charity.
Another thing taxpayers need to keep in mind is that if they are late on payments, the interest rate charged by the CRA is going up. Talk to us about that.
Absolutely. So in Canada, the way that I describe it is we almost have a pay-as-you-go system. If you have investment income on your personal tax return, for example, you likely are someone who has to pay installments to the government as you go. We can't just wait until the end of the year, depending on how large a balance we owe to the government, that amount is. We have to pay quarterly installments. And something that I think is going to start to catch people by surprise who are used to paying installments is that the interest rate on those installments has really ratcheted up. Right now, it's 9%, and it's going to be increasing to 10% in the new year. That's a heavy price to pay. It's also an amount of non-deductible interest, so it's not interest that's working for you from a tax point of view. And the key is to make sure is that you get your installments in on time. Even if you happen to be late, still better to make the installment payment now than waiting until April 30th so that you stop the interest clock and minimize the amount of non-deductible interest that you have to pay. And I think what's going to happen this year is that when people start to get their assessments, if they do owe interest, they're going to see a surprise because it's going to be numbers for interest that they haven't seen in many, many, many years.
Okay, I'm going to let Rob Tetro jump in with a question. He's part of the conversation as well. He's listening in from Winnipeg. Rob?
What are your thoughts on this change by the government with respect to the high net worth individuals that are donating shares in kind? And what long-term impact do you think that'll have on charities?
That's a great question. I have many thoughts. I'll keep them brief. So my concern, let me just discuss the issue very briefly. So the change that is potentially coming in, we're actually still waiting day by day to see if and when this legislation is officially going to be released and how it's going to impact charitable donations. So for 2024 and forward, the draft legislation indicates that a high net worth individual, so first of all, it has to be somebody who has taxable income of over $173,000. We're only talking about individuals and certain trusts. Those individuals may be stuck with something called alternative minimum tax. The alternative minimum tax effectively is going to increase their overall tax rate if they're subject to it. And a couple of the factors that can increase the impact of alternative minimum tax would be for an ultra high net worth person. If they donate shares of appreciated stock and their income gets pushed up to such a high level, they may see that a portion of the donation that they're making to the charity all of a sudden has a bit of a surprise tax bill at the end of the year. It's possible that for 2023 and in the past, for about the last 20 years or so, we've been able to say, donate appreciated stock, you're not going to pay any tax on that appreciation. We can't say that necessarily going forward. It's really going to depend on everyone's specific situation. The other challenge as well, for the same high net worth people, even if they're making a donation of cash, depending on the nature and sources of their income, for alternative minimum tax purposes, the deduction or the credit for that donation that they've made is going to be limited going forward. My concern is that for the charitable sector, it's possible that going forward, we're going to see a decrease in the amount of donations made. I don't know that it'll be a decrease overall, but I think it'll be more of a slowdown over time. A person may still want to donate the same amount of cash or securities. They just have to now perhaps manage their alternative minimum tax exposure and may make that same donation, but spread it out over a longer period of time. We'll have to see.
Okay, we've got about 9